there's no way I make a lot of calls, but there's no way I can call 250,000 people. So you need word of mouth, you need name recognition, you need people to know who you are and what you can do.
Yo, what is up, everybody? My name is Matt Drew, and I'm the host of the Go Big Live Real Estate Investors Podcast. And I am psyched out of my mind today to not have one of our typical guests, which is a commercial real estate investor, but I brought on a commercial broker. And the value in building relationships with commercial brokers is they've seen everything, especially this guy I'm about to introduce, because it's their livelihood to make transactions happen. So they are going to, by default, see more transactions and kind of like earn more third-party battle scars through the transaction process than you ever will as a investor yourself. So I have Mr. Bob Knakal that's coming on the show today, and he has been a real estate broker since 1984. By the way, I was born in 1984, so either he got to start in real estate while either I was in diapers or I was a twinkle in my father's eye, as he would have said. And Bob has overseen over $22 billion worth of transactions totaling over 2,342 buildings in the New York City area. I want Bob to tell his own origin story, so I'm going to leave it at that. Bob, thanks for coming on the show.
Hey, Matt, so great to be with you today. Great to be here. Love talking to real estate folks and particularly the investor community. So couldn't be happier to be here today and chat with you guys.
So recently you started BKREA, you're chairman and CEO of that company. Before I get into your origin story, tell us about what BKREA does.
Yeah, BKREA basically is a commercial investment sales company, and while I have a new business card, I'm doing exactly what I've been doing for over 40 years, which is representing sellers. You know, I've always had a very, very narrow value proposition. I only sell buildings. I only represent sellers. I only work on exclusives. I only work in New York. And that's worked for me pretty well in the past. So I'm continuing to do the same exact thing. We're mainly focused on land sales and very opportunistic value add redevelopment, like office to resi conversions, things like that. But there are a lot of new policy and legislation that is impacting the market very significantly here in New York. We're trying to take advantage of that. And we're just representing sellers who want to maximize the prices they get. I've always been completely agnostic as to who the buyer is. Just want to get the most bids I possibly can get to push the price up as high as it possibly can be for the folks that I'm selling buildings for. And, you know, I have a lot of clients who will specifically say to me, Bob, look, I'll never, ever buy a property from you. But if I ever sell, you'll be my first call. And you can't be all things to all people in life. So if that's my lot in life, I'm happy to be in that spot.
Excellent. I definitely want to talk about the power and leverage of focus. And today, listeners, we're going to be talking about how Bob was a former social media naysayer turned convert. We're talking about artificial intelligence and how that parlays into commercial real estate and how you can use it. And then also prospecting best practices. A lot of content on Bob's YouTube channel is around prospecting, because prospecting is an important thing in the broker. When you are a broker, I'm a former recovering commercial real estate broker myself. But before we get into all that, Bob, you were born, now you're here. What happened in between?
Oh gosh, lots of stuff, Matt. Lots of stuff. But you know, when I was growing up, and I played baseball as a kid, and always loved tracking my statistics. I was a pitcher, so even from when I was 8 years old in Little League, I tracked my pitching stats. You know, I collected baseball cards as a kid. Always spent more time looking at the back of the card than the front of the card, and that statistical orientation kind of stuck with me. You know, I went to college at the Wharton School at Penn. And when I got there freshman year, I wanted to be the next Gordon Gekko, like every other Wharton kid. And so spring break freshman year, I drove around Bergen County, which is in northern New Jersey, looking for a banking internship for the summer that would look good on my resume. Went to a number of commercial banks, investment banks. Came out of a Payne Weber office in Hackensack, New Jersey. Across the hall, I saw Coldwell Banker. I said, oh, great, another bank. Went in, gave them my resume. One thing led to another. They were the only ones offering summer positions to college kids. Took the job, loved it. Went back my next 2 summers, and then started with CB in Manhattan when I got out of school in '84. And very, very serendipitous start to my career. But couldn't be happier. I feel so blessed that I stumbled into this uh, career, which now is not only been my vocation, but it's also been a hobby of mine. So really, absolutely love the business, and can't picture myself doing anything but being a real estate broker.
Yeah, you and I have somewhat of a similar story, and with Gordon Gecko, because I grew up in a household where I always talk about like money is like air. You only start to notice it when there's not a lot of it around. And I got inspired by Gordon Gecko's character, and I was like, all right, I'm going to be Gordon Gecko, cigar chomping like Wall Street executive. And due to my naivete, I applied for banks when I graduated in 2006 from college, which was not a great time for young kids with liberal arts degrees and no experience to be looking for a job on Wall Street at that point in time. And the best job I could find was as a part-time bank teller at Chase Bank. I was like, okay, I know I'm starting from humble beginnings, but a couple of years I'm going to be next to the corner office, like yucking it up with Jamie Dimon every day. And my journey did not follow along that path at all. And I became a broker because I hated that job, and anything besides being a teller was a way out for me. And so that's how I got into brokerage myself. So let's talk about social media, because it's something we haven't really talked a lot about in this show. And I definitely want to talk to a former naysayer on it, because a lot of my clients that I'm advising on how to position themselves from residential to doing larger commercial deals is, building a thought leadership platform, and the importance of that, and how social media can be used as a tool to do that, to really augment your sphere of influence. So kind of tell me about your journey with social media, and how you converted from a naysayer to a evangelical about it, and what you've learned in the process.
Yeah, man, I'll tell you, I guess like everybody, I joined LinkedIn and Twitter probably '09 or 10, and I never went on it. My team would post a couple of things here and there, but personally, never went on, never knew how to get on. Thought it was a total waste of time. I'm like, how could people do this? Don't you have anything better to do? And my circle of friends is very real estate market participant centric. It seems like, except for 7 guys I went to kindergarten with that I'm still friends with, every one of my friends is in the real estate business in one capacity or another. So, when I'm out for drinks, I'm always telling stories about deals and things like that. And people would routinely say to me, "Hey, Bob, you should go on social media and tell these stories. People would love it." And so I guess people ask me why I got on social media. I'm the first to admit peer pressure was a big reason, but I thought, towards the end of 22, I said, all right, let me get on, let me try it for 3 months, see what happens. Looked at the horizon, looked at what other brokers were doing, and it was a lot of, hey, I just listed this, I just sold that. And I'm like, during the Massey Knakal years, I spent a lot of time trying to motivate the troops. So I said, hey, maybe we'll do some motivational stuff. And then, people want to hear deal stories and what happened behind the deal. How did you overcome impasses, things like that. So I said, let's do a deal story day. I had collected about 22 boxes full of stuff from the old days. So I said, hey, let's do some throwback stuff and look at some of this old stuff. And then, I share my nuggets, which the Knakal nuggets are lessons learned over time. It started just as 26 lessons that were learned in the 26 years of running my firm, Massey Knakal, which Paul Massey and I ran for 26 years and sold to Cushman in 2014. So the nuggets now, I have 100 nuggets, and it's been basically lessons learned over the course of my career. And so I said, let's have a different topic, different genre of post every weekday, and see how that goes. And the first real impression I got from social media that was very insightful was, today I have my social media manager, Mo Regalado, is out in Washington State, and she does all my posting and creates the videos and does all the stuff for me. And today we post a new post every day at 7:30 a.m. Eastern time. And back in the early days, I was posting around 10 o'clock. And in the first 2 or 3 weeks, I posted a picture of me standing on my map, my development site map, which the map room is based on. And it was a picture of me standing on this map in my living room at my country house. And the map's 24 feet long, 10 feet wide, and the reaction was tremendous. But I'm in the JLL offices, and this was a Wednesday, and we did the post 10 o'clock. By 11 o'clock, I had 8 people come up to me. Hey, I saw that picture of that map. That's the coolest thing, blah, blah, blah. And so two things struck me. One was, boy, this social media really has a lot of reach. And the second thing was, what the heck are people doing looking at social media between 10 and 11 o'clock in the morning on a Wednesday? Go make some calls. Uh, so I figured, hey, if it's happening here, it's probably happening other places. And that's been really kind of probably the biggest impact that it's had. Is I'm shocked at the reach that social media has. And now, I just finished year two, which was 2024. And on my social media platforms, I had 21.8 million impressions. So if you follow me on social media, I'm a big proponent of the saying, it's not who you know, it's who knows you. And I think that's particularly true because just in New York, in the four boroughs, we don't cover Staten Island, but in the four boroughs of New York, there are 176,000 investment properties owned by 250,000 investors. There's no way I make a lot of calls, but there's no way I can call 250,000 people. So you need word of mouth, you need name recognition, you need people to know who you are and what you can do. And so I focus a lot with my coach, Rod Santamassimo at the Massimo Group. We focus on market presence initiatives, and market presence is everything. It's making phone calls, doing email blasts, hard mail, text programs, networking, public speaking. But social media really takes market presence and puts it on steroids. And so it's been a great thing for me. I have now friendships with people all over the country, all over the world. The Knakal map room has become kind of a cult thing on social media. I get people come here from Australia or Germany or Sweden for vacation, and they call me and want to come in and take a visit to the map room. So it's been a neat thing, but very, very happy that I got involved in social media, and it's put me in two things. It's put me in position to get business that I wouldn't have gotten otherwise, and secondly, it's putting me in position to get in the way of information that's going to help all my clients. You say why. I think there's a misunderstanding about this. That people say, oh, well, Knakal, you do all this stuff, you're in the press, you go on TV, you're doing social media, it's all about your ego. Those people just don't get it. They just don't get it. I represent people who are selling buildings and want to get the highest possible price for their building. I want to get them the highest price for their building. I only represent sellers. If I sell buildings at a low price, I'm putting myself out of business. If I sell a building for a really, really high price, I'm going to get 10 more buildings to sell. So I want to do everything possible to get in front of the one investor in the world that is likely to pay the highest possible price for one of my clients' buildings. And if that comes through a post on Twitter or a something I do on LinkedIn or a post that I put on Instagram, I don't care how it comes to me. But if somehow I'm getting in the way of information that's going to lead me to get a better outcome for my client, I'll do it. I told people, look, if it would get a better price for one of my buildings, if I put a sandwich board on and had an organ and a monkey on my shoulder. If that would get me a better price, I'll do it. So I'm willing to do anything to help my clients get the best prices possible.
Excellent. Yeah. And to add on to that, there's certain intangibles, I think. I mean, a lot of, I'm a former broker, and a lot of other brokers, they use the social media, they do it for 3 months like you do. And like, I didn't get a single listing out of it, or I didn't get a single buyer out of it. And I think it takes time, it takes persistence, but also the intangibles you start to see. And some people like look at me like, hey Matt, I've been trying to get a hold of this guy for 2 months. He won't give me a call back, like, blah, 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 blah. And I pick up the phone, I call him, and I get him directly. People will pick up your phone calls when you call them. And that is incredible to be able to efficiently open doors more often. And there's another, reason why I go on the press, for instance, talking about local real estate policy. It's not because I want to make myself a target for hate, for instance. It's because of that name recognition that comes with it. So that being said, so in terms of the next topic, artificial intelligence, a lot of people are kind of like, misunderstanding it. There's kind of like this, early wave of just kind of, junk that's out there that's kind of like, garbage in, garbage out. Not a lot of people in the commercial real estate field have really been talking about artificial intelligence in a intelligent way. So what do you say on how it can be used as a tool, and how you're using it at BKREA?
Yeah, well, we're using AI in three ways. And I will tell you, I'll start out by saying I am the least technologically savvy person in the world. I'm
Mm-hmm.
happy if my cell phone goes on. But I realized early on that, AI is going to change the world. Back in '84 when I started, I had no computer on my desk, no fax machine, no cell phone. We carried rolls of quarters around to go to the phone booth on the corner and make calls. The world has changed so much in the last 40 years, but I think the extent to which it's going to change over the next 5 is going to blow away the change over the last 40, and it's due to AI.
Mm-hmm.
So when I started BKREA, the first thing I did, I hired a COO who is an AI guy. Seth Samowitz has started AI companies. He worked in driverless cars for 6 years. I figured if this guy can make a car drive itself, he can help me sell some buildings. So we've been on the AI bandwagon since the beginning, using it in three ways, basically. We're using it for prospecting, using it for deal execution, and thirdly, data interpretation. And the first two are relatively straightforward. Both prospecting and deal execution are nothing more than funneling processes. You start with thousands of people, you get down to hundreds of people, you get it down to dozens of people, get it down to a few. AI is extremely helpful making that process more effective and more efficient. And there are a number of things you can use off the shelf that are helpful. We're developing our own proprietary systems to do a lot of this stuff, but that's pretty straightforward. Where I think AI has the most potential, but at the same time will be the most difficult for the industry to take advantage of, is on the data interpretation side.
Mm-hmm.
AI has the capability to do millions of calculations a second. And unfortunately, most data sets in the industry are very, very poor. I will tell you that because absolute numbers are not as meaningful as the relationship between numbers over time. And what I mean by that, if I tell you that in Manhattan in 2019, there was $26.3 billion of sales volume, you really don't know what to think of that
Mm-hmm.
until I tell you that at the peak of the market in 2015, it was 57.4 billion. And during COVID in 2020, it dropped to 11.1 billion.
Mm-hmm.
Now, all of a sudden, the 26.3 starts to have some feel to it. In the same way, it's the relationship between numbers in a data set over time. The longer time you have it, the better. But it's also important that the calculations be done consistently, and we're using the same methodology.
Mm-hmm.
If I ask 10 people to calculate a cap rate on a deal, I may get 10 different answers,
Mm-hmm.
because are you using trailing 12? Are you using forward 12? What are you doing with vacancy? Are you making projections? How are you making projections? What's your stabilized vacancy factor?
Mm-hmm.
So I think you look at data, and for the numbers in a data set over time to have integrity, they have to be calculated the same exact way. So
Mm-hmm.
one of the advantages we have is, because I've been so data centric, I have data sets that are now 40 years old that have been calculated using the same exact methodology over time. So, like, one of the things we're really excited about, we're coming out with the Knakal Land Index, which is looking at the fluctuation in land value over 40 years in Manhattan.
Mm-hmm.
And not only, we've disaggregated the data. Most companies will say, hey, land last year in Manhattan sold for an average of $412 a buildable foot.
Mm-hmm.
Um, that's like saying the average price last year of a peach, a bowling ball, and a 2x4 was $11.50. Uh,
Uh-huh.
we disaggregate the data into rental land, condo land, hotel land, office land, a miscellaneous bucket, and we've been working with data scientists for 2 years now, to come up with algorithms and AI formulas to interpret this data, the fluctuations in the data, and compare those fluctuations to things within each of the different property sector silos. How have rents fluctuated? How has occupancy fluctuated, et cetera, et cetera? But then also comparing those fluctuations to macroeconomic data.
Mm-hmm.
Um, you know, uh, Interest rates, inflation, price of gold, price of oil, S&P 500, consumer sentiment, Dow Jones Industrial Average, et cetera, et cetera. There's 26 metrics that we're comparing these fluctuations to, and looking at things um, like static correlations, lead correlations, R squared factors. All these things, I didn't even know these things existed until I started getting into these things. But like the R square factor is the predictability that a certain metric has relative to these fluctuations. And so it's really, really interesting. I learned a new term called jiggering, which is the way to take into account that if you're looking at fluctuations in stock values, if something happens today that's going to make me buy stock, I can go and in 5 minutes I can buy a share of stock.
Mm-hmm.
But in real estate, if something happens today that's going to make me want to transact, that that may show up in the data set 6 months from now. So
Mm-hmm.
how do you allocate for the lag? So that's called jiggering. So we were looking at all this stuff, and hopefully shortly we'll be coming out with the land index, which I really think will be a groundbreaking piece of research, because to my knowledge, I don't think anybody's done anything like this over a 40-year period. We have the same data set in the multifamily space, with cap rates and GRMs, price per unit, price per square foot, going back 40 years. That's as soon as we get the land index done, we're going to do the multifamily study. But just some great info, and really mind blowing what AI can do with this stuff.
Bob, now not all of us have a horse in this race on Manhattan real estate or New York City real estate, but what is the data? And and you've said before that New York City is kind of like a microcosm. What is the data telling you about the future prospects of real estate in New York City, and why?
Okay, well, firstly, I think a couple of things. One, um, this correction has been very different from previous corrections in two main ways. One, different property sectors are moving in different directions at the same time. Two, lender behavior is very different this time around. And there are a variety of reasons for that, which, we can go down a rabbit hole for a couple of hours talking about it. But, I think what we're looking at for 2025, and it was very controversial when I said, I was on CNBC back in February of last year and said that 2025 would see the biggest sell off in the history of New York City. I believe that it will be true. But if you looked at first quarter 2024 numbers, they were running flat with 2023. By the end of the second quarter, we were up about 40%. End of the third quarter, up about 60. We're finalizing our numbers now. And I think we'll see that the market was up 80, 90% over last year, over 2023.
Hmm.
But I think 2025 will see the highest turnover rate we've ever had. Using Manhattan as a microcosm, south of 96th Street, there are 27,649 properties. The average turnover rate of that supply over the long term has been 2.6%. The
Hmm.
lowest it ever was 1.2 in 2009. The highest it ever was 4.3 in 2012. I think next year we're going to see turnover at 5 or 6%, way higher than the 4.3% that was the previous high. And the reason for that is that because property sectors are moving in different directions at the same time, we are going to have very robust discretionary sellers and robust non-discretionary sellers at the same time. That's never happened in the past 40 years.
Hmm.
Usually in good times, there's a ton of discretionary sellers. In bad times, there's a ton of non-discretionary sellers. We have both of these groups of folks who are going to be transacting, and we're already seeing it. It is off the charts. Great time to be a broker, great time to be a title closer, great time to be an attorney. If you rely on transaction volume, 2025 is going to be an outstanding year.
So, what are the drivers, would you say, in that transaction volume going up? Is it just pent up, or are there actual like real fundamental drivers behind that?
No, there's pent up demand to sell. We've been below, and interestingly, that 2.6% average I mentioned, it was 2.6% at the end of the 80s, at the end of the 90s, at the end of the noughts, and at the end of last decade. It's been very, very consistent.
Hmm.
And we've had 7 years in a row where we've had below trend turnover. The longest period we ever had previously was back during the S&L crisis in the early 90s when it was 4 years. There's pent up demand to sell, and there are sectors that are doing well. Our retail sector is doing really well. Our hotel sector is on fire. Land is making a comeback. Hotels doing great. We the sectors that are doing well will see discretionary sellers because things are getting better. People have been wanting to sell but haven't been able to. So a lot of people are going to take advantage of market conditions. On the other side of the coin, we have our multifamily sector, which has tremendous political headwinds. And those headwinds are creating big problems, particularly on the refinancing side, where 25, 35% cash in is required to effectuate a refi. Rates are about twice where they were. So a lot of folks are having to sell because they either don't have the capital to effectuate the refi or are choosing not to put it in. And then our B and C office sector, which you have to also disaggregate office, looking at Class A new construction office is doing relatively well here. B and C office still has a lot of challenges, and a lot of folks have no choice. They have to sell, and so we're going to see both of these groups of sellers are going to be very active simultaneously.
So, Bob, you mentioned something about political headwinds. We have a lot of listeners out of New York State, right? And New York City was the first adopter of good cause eviction. Have you been seeing any chatter or any market movement in sentiment, especially as it pertains to multifamily as a result of this legislation that was passed in Albany?
Yeah, well, Matt, this is a topic I could probably spend 8 or 9 hours on very easily. I'll tell you a couple of things that the multifamily market in New York, the performance of that market is now more highly correlated to public policy than it is to supply and demand,
Wow.
which is really a travesty because a lot of our policy is completely misguided. Use as an example, it's really, good cause eviction was another nail in the coffin. And really, the many nails in the coffin were the what's called the HSTPA rent law changes that happened in June of 2019. And I'll just talk about one of several programs, and tell you how it's impacted the market. Go back to 1978, Yankees and Dodgers in the World Series. The Goodyear blimp is over Yankee Stadium, pans out. 6 fires going on within 3 blocks of Yankee Stadium. Why was that happening? Well,
Mm-hmm.
it was happening because in those days it made more sense for some people to burn their building down than to invest in it. The
Mm-hmm.
dilapidation rate in 1978 in New York was 14%. 14% of our apartments were in such bad condition they were deemed uninhabitable by the city.
Mm-hmm.
So the city enacted legislation to create 2 programs to incentivize investment in the housing stock. One was the MCI, Major Capital Improvement Program, for doing things like putting in a new boiler, renovating the lobby, putting on a new roof, changing all the windows.
Mm-hmm.
The second program was the IAI program, the Individual Apartment Improvement Program. This was for upgrades to the apartment, put in a new kitchen, new bathroom, new flooring, et cetera, et cetera. Those programs provided a 30% return on invested capital. So what did the private sector do? The private sector dumped tens of billions of dollars into the housing stock in New York, such that in 2019, that 14% dilapidation rate had fallen to 0.04%.
Mm-hmm.
Great policy. So what do our policymakers do in 2019? Marginalize both of those programs such that there's a disincentive to invest in the housing stock now. So
Mm-hmm.
consequently, there are tens of thousands of apartments that are sitting empty. So our politicians say, oh, we want New York to be more affordable for everybody. But they're being hypocritical because every single piece of legislation that's either passed or been ignored since 2018 has done nothing but constricted supply and exerted upward pressure on rents, making New York less affordable for everybody. So, all you would have to do is reinstate the MCI and IAI programs, and you'd probably have 60 to 80,000 apartments under gut renovation within 2 weeks. How
Mm-hmm.
much flooring would you sell? How much sheetrock? How many refrigerators, sinks, bathtubs, toilets? Come on, it's ridiculous. The economically stimulative impact of bringing those programs back would be unbelievable, and it would alleviate some of the upward pressure on rents in New York. So you talk about policy. It's just really remarkable how highly correlated market performance in multifamily is to public policy. And good cause eviction is just, the HSTPA in 2019 took away the ability for investors to extract upside potential out of the 1 million rent stabilized apartments that we have here in New York.
Mm-hmm.
The good cause eviction basically has taken away the ability to extract upside in free market units. That's
Mm-hmm.
all you have is rent regulated and free market units. There's nothing else to go after. So
Mm-hmm.
consequently, probably 85 to 90% of my client base in the multifamily space that was active in 2018 will no longer buy an apartment building in New York, regardless of price. They're buying all over the country. That wave. I would argue that the HSTPA in New York City in 2019 was the cause for driving cap rates on multifamily down around the United States.
Mm-hmm.
Because I have clients buying in Florida and Texas and Tennessee and Arizona and New Mexico and in the Midwest, all over the place, because they just won't buy in New York anymore. So values have gone down. We have a lot of folks from out of New York that are buying multifamily buildings today. It's really had a very, very profound impact on the market.
Yeah, I mean, I first heard of MCI when funny story, after HSTPA was passed, we organized a bunch of landlords out of Western New York and also tenants too on a couple of school buses. We came down to the Pit in Albany and saw all these tenant organizers from New York City holding up these signs that said "Stop MCI Scam," and I was like, "What the heck is MCI?" And I was talking to these tenants, very, very with candor on this thing, just to get to understand the position. And they're basically saying is like, my building needs a new roof and my landlord wants to jack up my rent, or increase my rent to do that. I don't basically, I don't want them to replace the roof because my rent will go up. And I was like, oh my gosh, like this thing has extreme systemic impacts on accessibility of naturally occurring affordable housing. I just don't understand it. Now, Bob, I have to ask you, I did want to talk about prospecting. You've been generous with your time. Do you get time to talk about that?
Yeah, absolutely, Matt.
Okay, all right. So yeah, we could talk for hours on housing policy, but I definitely want to get some red meat on prospecting. So let me just paint a picture for you. I have a list of properties and addresses. I have some contact information, and I got I'm sitting in front of my phone, right? What is the order of operations that whether I'm a broker or somebody who's prospecting for maybe small mom and pop multifamily that most commercial brokers won't touch, like on what I should do once I have that phone in my hand and that contact list?
Yeah, most important thing is actually to just start dialing. That's the most important thing. You got to be on the phone and dial away, and a matter of doing it. Number one, you have to be ready to offer something of value. When you're calling a property owner, often their building or their portfolio holds the lion's share of their net worth. So if there's something going on in the market that's going to impact the value of those properties, they should want to hear about it.
Mm-hmm.
So have something of value to offer them. Be personable. Make sure you follow up. If you say you're going to send them something, make sure you send them something. But just the goal is to try to create a relationship with the owner. Let them know what your capabilities are, what your knowledge base is, how you could potentially help them. And the most important thing about prospecting is just to do it. And I know we're all so busy with everything going on in our lives. If I asked you today to block out a 3 or 4 hour window to make prospecting calls tomorrow, almost nobody could do it.
Mm-hmm.
But if you block that time out 3 or 4 weeks in advance, you'll be able to have the time to do it. And you really have to do everything you can to be disciplined about sticking to keeping that time sacred to make those calls.
So there's no like Jedi mind tricks or super like ninja moves and that sort of thing that you would suggest on the conversation. Just pick up the phone and dial.
Just pick up the phone and dial. Absolutely. Got to do it. Part of it is, today it's a lot easier than back in the old days when publicly available information wasn't around. It's relatively easy to track down the owner of a property today, but make sure you have the information correct. Try to get their email address, try to get their cell phone number, and once you have your database corrected and perfected, just dial away.
Mm-hmm. Yeah, and I think also it takes a lot of patience as well because you're dealing with a quintessential like unmotivated seller or discretionary seller, and there's this old adage that rings in my head all the time when I'm doing something I'm not getting results. It's no pain, no sale, mm-hmm. And a lot of those sellers or owners of properties are going to be a seller at some point in time, and it's always going to be, I wouldn't say always, but a lot of times instigated by something of pain, whether it's new legislation, whether it's, hey, I had more tenants that put in their notice to vacate than I had anticipated this year. I'm going to have to redo all these apartments, and I think it's time for me to walk away from this thing. So what do you say to that on the patience side of things, and how much patience, how much follow up is generally to be expected?
Yeah, well, I think to be an effective prospector, number one, you need to do it. Number two, you have to understand the probability of success. So, for instance, I know that the long-term turnover rate in Manhattan is 2.6%. I would estimate that half the stuff that goes on the market actually sells. Mm-hmm. So that means at any one time, about 5% of the properties are on the market. What does that mean? That means if you call 20 owners, 19 of them are going to say no to you, and one is likely to say yes. Mm-hmm. So if that's the case, you have to have the mindset that, hey, if I get hung up on 19 times in a row, I should be feeling great because the probability the next one's going to say yes is very high. And you just have to keep going. Look, if you decide you're going to sell X type of property in X market and you have an owner on your list, you have to keep going after them. I told the story many times about the big developer in New York City, Harry Macklow. Harry was big owner, owned a little building in my initial territory when I started out. I called him for 2.5 years, leaving messages for him every month,
Mm-hmm.
and never picked up the phone. I called his office one night about 7 o'clock. His assistant had left. He picked up the phone and, hey, Mr. Macklow, it's Bob Knakal from Coldwell Banker. Yeah, I know who you are. What do you want, kid? Uh, and I've done 23 deals with Harry now, about $400 million worth of stuff over the years. He's become a great client, and you just have to keep at it. You just have to keep at it, and persistence breaks down resistance.
Mm-hmm.
And if you just keep at it and go forward on all fronts when you're prospecting, make your calls, send your emails, send texts, send hard mail, do all the things you can to stay in front of folks and make them feel like, hey, if I talk to this person, I'm going to learn something, or it's going to benefit me in some way, and to put me in a position to make a better decision about what I'm doing with a particular property or in a particular situation. And once you create value in yourself that way, people are going to want to talk to you. So you have to keep at it. Number one, you have to start. Number two, you have to keep at it.
Yeah, Bob, and a slick trick that I've used that I learned from my days of selling Amway is always book an appointment from an appointment. So when I'm leaving a voicemail message for somebody, I'm always leaving on the voicemail message that, hey, I probably caught you at a bad time, but I'm going to try you next week at 4 o'clock. And I keep that process going over and over again, and I've actually put it on my calendar. So I'm actually like making a promise to them and also making a promise to myself. So that's really worked for me and the follow-up system that I've integrated within my own prospecting. Bob, you've been really generous with your time. How do our listeners learn more about you and BKREA?
Sure, Matt. Well, you can go to bkrea.com. You can go to bobknakal.com. That's Knakal. Or feel free to email me, bk@bkrea.com, or call me on my cell, 917-509-9501. And love to hear from folks.
Absolutely. Bob, I look forward to seeing you in the green room. Thanks for coming on.
Matt, thanks so much.